question, though, about what this means for the workforce that is most directly affected with this, with respect to docking, with respect to trucking, with respect to railroads.
We've got to talk about a payrolls report in just a moment. It's 5 minutes away. The estimate in our survey, 138K. The previous figure, 228. Tariffs in focus. Policy volatility down in Washington, D.C. Is it too early to expect to see it in these numbers this morning? Your payrolls report just around the corner. Reaction.
Money day, money day, money day.
Research. Jeff Rosenberg of BlackRock.
All right, we've got NFP in focus. We've had a couple of pushes last night to get rid of some of these areas. All right, for gold, we're in prime selling area for gold, and we'll see how that does. NFP is in about 3 minutes, so kind of need to tee up from now. I do want to see what gold would do today. What do I think the dollar will do? Okay, so we've got yesterday's low and high intact. We've got this daily imbalance down here as well, right? So if we're looking at it, ideally we could get a pull down into the imbalance and then a push back up, right, on the daily perspective. To be honest, I'm quite neutral. I want to see the dollar strong, keep going. I do want to see EU drop as well, some more. I still do have this short setup here for EU, so let's see how that does. And for gold, to be honest, gold, I feel like gold might move erratically today. You know, gold might do a little something, something. Yes, Gift, how you doing? How you doing? How you doing?
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
From our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes
GDX
everything.
up pre-market for
US
once.
jobs numbers are released. Bloomberg
Gold 4 hour, we can retrace back up into this area, but I want to see what we do inside of the imbalance for sure.
Africa.
We had a mad spike across stock market last night during after hours. I think there was some earnings as well that came out. Anyways, let's just take a look at gold, see what gold wants to do. Releases in about 10 seconds.
And ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Gold's dumping. Dollars pumping.
The jobs report is 25 seconds away, and going into it, your scores look like this. Equity futures positive by 0.5%.
We've had a bit of a spike to the downside so far.
Coming into Friday, the longest of the year so far. We're looking to make this day 9, and the fate of this market could be in the hands of one man, the President of the United States. And this data, the jobs report just around the corner.
Alright, so NFP came out at 177k. Forecasted was 130k. So that is better than expected. Unemployment has remained the same. Okay. So far it seems positive. Seems positive for the dollar so far.
In terms of the month-to-month numbers, The private payrolls were up 167,000. Manufacturing lost 1,000 jobs. The forecast was for 5,000. Unemployment stays at 4.2%. I'll check on the three-digit number in just a second. Labor force participation ticks up 62.6%. And U6 falls to 7.8 from 7.9%. Average hourly earnings come in a little weaker than anticipated. 0.2% for the month, 3.8%, same as last month for the year over year. And here's an interesting one, 34.3 average weekly hours, 34.2 in the prior couple of months. And if companies were going to be cutting back, they'd usually cut back on hours before they cut back on people. This month, they did neither. Let me check into the rest of it. You know, and John, the whisper number 120, Wall Street was leaning towards a weak report. How are they reacting now?
The risk was a downside surprise, the reality an upside surprise. And Mike, I can tell you, good news is apparently good news. Equity futures session highs up by 0.9% on the S&P 500. On the Russell, we're up by 1.7 in the bond market, unlocking higher yields at the front end of the curve. Yields up by 6 basis points on 2s to 376. On a 10-year, up by 5 to 426.76. In foreign exchange, a touch of dollar strength relative to where we were. So you're up 14.
Yeah, you know, it's interesting to me that the equity market is be taking more of a signal because you're seeing yields pop at the front end, but not as much as you would expect if suddenly this took all rate cuts off the table.
I mean, we're definitely getting reactions from the market, but
earlier when he said it really gives a sense of how much momentum there is coming in. And to Mike's point, there is still American.
it's not anything crazy.
Expressed as it is in April numbers in terms of how much of an upside surprise.
In terms of a setup, nothing just yet.
That this economy has going into what is a policy shock, and for the moment at least, you're not seeing that weakness in the economic data at the surface level. Mike, I want to bring you back in for the details. What do you see beneath the surface?
Well, it looks at this point like we're seeing unemployment rate. This is the one that the Fed really cares about. An unemployment rate.
Are you guys looking at any setups at the moment?
Because we're hiring 436,000 people were hired during the month, according to the household survey, while only 82,000 were listed as unemployed. The labor force rose by 518,000. So a lot of people coming in to look for jobs at a time when we were told companies weren't hiring. So that is kind of interesting. Construction, 11,000 jobs, which is reasonable. This is the time of the year when you would.
Mark says gold, Gift says gold, just waiting it out at the moment.
There was this fear that we wouldn't be able to find them because of the deportations and border closures. So some interesting news there as well.
Yeah, let's see if gold can drop from here, you know.
Really important. It's not just about the demand side, it's also about the supply side. This is a good report all around in terms of demand for labor, supply for labor.
I think we're in a decent area for gold to short down, to be honest.
So this is something that, as we just heard,
the real question is, are we going to get it now or later?
Economic exceptionalism. It says we have momentum going into a difficult period, and the question just is, will this momentum be strong enough to get us through it?
Do you have confidence we'll see a repeat report next month?
No, I don't. I think the world did take a shock, a significant shock, so we're going to see. But it's important, you know, whenever you go into a tricky
GU is
situation,
incredibly bearish, guys, man.
Momentum gives you a certain amount of resilience.
GU looks like it's going to take out the lows of the week.
Stephanie Roth of Wolf Research into the conversation.
So this low's going to get taken.
Your reaction to this one, please.
It was a strong one. Granted, we had some, downward revision to the prior month, but the net trend is pretty strong. The challenge is looking forward. There's a pretty big cliff from an economic perspective heading into the next couple of months. And if we don't get a significant downward shift in the tariff rate from China, then things like the strength in transportation and warehousing is gonna very much shut off.
If I were a pessimist, not that I am, but if I were a pessimist, if I wanted to look at the negative side of this, I would say it gives the Fed no excuse to even come close to cutting rates, and that potentially they have no reason to signal that they are concerned about a true weakening in the economy that is politically fraught as well as not represented in the data. How much does that increase the backside of the year and the potential weakness that you could see down the line if the Fed is disinclined to really make any movement?
I think that's right. There's no reason for the Fed to be cutting or signaling that they're going to be cutting anytime soon. At this point, the economy is fine. They have to be reacting to the unemployment rate, which is kind of steady at the 4.2. And they're concerned about the inflation backdrop, but for now, they just have to sit and wait. They have to wait until they see an actual rise in the unemployment rate before they can make notable changes. And at this point, the economy is okay, and consumption has been okay up until this point. So it's just wait and see for the Fed.
On the flip side, to Mohammed's point, and this is the reason why this is such a mentally twisting kind of moment, you could say, well, the economy has a lot of momentum. We're coming into this very strong. We might get something of a hit, but it might be a disinflationary shock, if anything, which might help out the Fed. And then we end up back in the soft landing type of narrative. How much does this give you confidence that we still have that potential, even amid all of the uncertainty?
So base case
There's not enough.
is the economy can
There's not enough here.
avert a recession.
There's not enough.
Barely.
There's not enough here to act, guys, man.
Change their tune a little bit, which we are starting to see out of Washington to some extent. The headlines around potentially
There's not enough.
Conversations with China certainly help.
At least for now,
So
anyways.
base case is that they'll change their tune a little bit. If we end up with 10% across the board tariffs and tariffs on China of 50%, maybe 40%.
There's definitely not enough.
Then the economy can be okay this year. You just have a
Gold does look
1%
like
or
it
so
does want to collapse, you know.
But having the solid
The recent
momentum
4-hour
is
candle
difficult.
that's printing looks pretty
How
good.
much time do they have to change their
Right,
tune, as
with
you
this
said,
4-hour
to avoid the
candle,
most difficult economic.
if we can get this 4-hour candle engulfing this one, then all we need to do is wait for the next 4-hour candle to open, make a high, so take an entry somewhere around here, and then short, put your stop above this candle's high. And we should be okay, at least for some TP1 and 2. So for now, I kind of want to see how the 4-hour candle is going to close.
Was 138. The unemployment rate expected to hold at 4.2%, and it did, 4.2%. They're the two headline numbers we often think about. Mike McKee, you look beyond the headlines. Sum it up for us. If you just missed it, what did you miss?
Well, right now, what I'm seeing is some impacts, it looks like, in the tariff areas, or to-be tariffed areas. Computers lost, construction lost 4,000 jobs. Semiconductors lost 1,100. Primary metal jobs were down by 100. Apparel jobs down by 300. And government workers down by 9,000. Leave out the Postal Service, but they got some Doge cuts too, and you have 8,500. So you are seeing some impacts from the administration's moves already. In terms of the unemployment rate actually rises by a few basis points. The three digits is 4.187 from 4.152. So we came very close to getting a 4.3 handle, but it didn't move. And as you're talking about, unless the Fed sees the unemployment rate moving, they're not moving.
The equity bulls getting everything they want this morning, Lisa. A better jobs report, the potential for talks between the US and China, and potentially a 9th consecutive day of gains on the S&P.
I guess I'm trying to understand, if you flip this on its head and you talk about real strength in the economy and you talk about the potential for a deal, are we underestimating the inflationary pressure? Are we underestimating just how much growth there is that potentially is not being accounted for by the Fed or by the rest of the universe? I don't know. I'm just wondering, maybe people were saying there's a difference between the bond market and the stock market, and the bond market's so smart and it's always right. Maybe the stock market was right. And all of a sudden you need to reprice things on the other end.
Pretzels, is that what we're making this morning? Look, let me put it this way. Whether this number was weak or strong, the risk was always that we extrapolated it out. The policy shock that we've had in the last month is so large that the distortions you'll see in the data, not just this month, the month after that, the month after that, just to go back to Gene Soroka again at the Port of LA, he's telling you, he's basically telling you what things look like now and how long it'll take to get things back to normal, even if you strike a deal tomorrow. Which
is the reason why, if you take a look at the 2-year yield, it's almost completely retraced back to where it was before this print, because people are looking through this. They're saying this is not what we're going to experience in the upcoming months.
Jeff Rosenberg of BlackRock jumps into the conversation now. Jeff, welcome to the program. We want your thoughts on where things are, how we're set up, going into the opening bell 50 minutes away.
Yeah, first point here, just agree with Mohammed's take that this is about where is the economy coming into the shock. And this is a good report, and that's important. You've got more resilience when you're coming to a shock from a place of strength. You look through the report across payrolls, across earnings, hours worked. It's all strong. Now, that's the first point. The second point is, unfortunately, it's really less relevant to the go forward, because this is kind of, yes, it's our first hard data, but it's really pre the tariff shock. And as we're discussing that tariff shock and the size and the scope and the amount of exemptions, that's evolving, but none of this data really reflects the impact of the shock, and we'll have to see that data show up. And that's the third point here, is that the Fed, and they're going to have to wait, and they're going to have to wait until they see any kind of impact in terms of a rise in the unemployment rate. And until you see that, you're not going to really see any kind of expectations of Fed intervention. And as the other guest was saying, it's very hard for them to be preemptive and to go to forecast dependence. This is data dependence. And this is lagging data, and so that will be, really one of the last things to show up as we talk about that in months ahead.
Jeff, if I may push you a little bit on what you just said. So how are you navigating all these serious puzzles, soft data versus hard data? What about the sequencing? You hear some people say, yeah, we're going to slow down, but don't worry, there's deregulation, there's tax cuts coming, we're going to bounce right up. There's so many issues right there that people are debating in a very genuine manner. When you put it all together, when you look at the growth rate for the US, the IMF last week took it down from 2.7 to 1.8 for this year. A lot of people thought they would go further down. They will go more towards 1%. Where's BlackRock right now in terms of how all this nets out in terms of growth for the US this year?
Okay, so right now, what I'm noticing, firstly, is the dollar turning around, yeah? Even though we've had positive news release, we're seeing the dollar turn around. Let me show you guys the dollar. So we had this hour candle, right? Which was mitigated into this morning at 9 a.m. Gave a short move to the downside. We've had a news release, we spiked up, okay? Played into the same candle, and now we're rejecting lower. Now, when I look at the 5-minute time frame, of course, the most significant lows are going to be this low here and the most recent low that we made during London session. Now, if we start breaking the structure, okay, especially this low here, which we've just done with a little bit of a wick there, right? If we start running through this area, then there's a good chance that we're definitely going to head down lower, okay? I cannot deny this rejection here. I cannot deny this current 15-minute candle. I cannot deny the half-hour and the hourly candle and how it's printing right now. And when we looked on the daily time frame, we do have imbalance to the downside where price can head down towards. Okay, remember it is Friday, it is the last day, so you need to kind of anticipate how this weekly candle may close. Do I think it's gonna close bearish? Not in particularly, but I wouldn't be surprised. Okay, so for now we're just gonna monitor it, and today is definitely smash and grab. Try to grab a little small piece of the pie and then keep it pushing. Okay, I would still overall like to see the dollar head higher, but at least for now, there isn't any evidence to tell us that it would do so just yet. Okay, so now we're just going to keep monitoring, right? Watching gold, watching EU, watching the DXY, and see how those close on the hourly and the half hourly time frames. Okay, guys, if you're watching the stream and you're new to the stream, don't forget to subscribe to the channel and leave a like, as it does help with the YouTube algorithm for the channel. And if you enjoy this type of content, I provide more of this content for free inside of my Discord. Link to the Discord is in the description box down below. Right, if you guys have any questions, feel free to message inside the live chat box. Let's have a conversation. What pairs are you looking at? And yeah, I'll be happy to answer questions that you may have. So for now, again, just trying to see what gold wants to do inside this hourly imbalance. For now, there's not enough data for any of us to work with. Okay, right now, just looking at that rejection that we had up there, it's given a little bit of doubt, because if the dollar does drop, then gold should head higher, right? So I will most likely wait for the hourly candle to close and then see where we are and then make a decision based off of that. And then, of course, New York Stock Exchange open, and then we'll see where we are by 3 p.m. Other than that, let's just keep listening to some Bloomberg, as I just want to know what analysts are saying and what's going on around the world economically.
Shortening our what we call key rate duration. Where are we getting our exposures for the diversification? Looking much more to the front end of the curve than historically you would have thought, hey, the back end is really the best place. In today's environment, I think the back end is much more vulnerable, and a stagflationary kind of outcome really changes how you think about defensive positioning in fixed income portfolios.
We were talking to Priya Misra earlier of JP Morgan Asset Management, and she said that 30-year treasuries were the risk asset right now and doesn't really want to go there. Do you feel the same?
Yeah, it's a similar viewpoint. Now, you got to be careful because there are a lot of cross currents. There's a lot of potential for policy intervention and some other changes. And you have to also be careful that market positioning, as Priya's talking about, it's a very popular kind of crowded viewpoint that the back end is vulnerable. That being said, I think the base case is, and we've seen it here, we saw it in the post-tariff announcement, a big curve steepening, that you do have the potential here. You know, it used to be in the zero interest rate environment post-GFC, flight to quality was a curve flattener. You wanted to own the 30-year. You know, in an earlier era, long before the GFC, we used to think flight to quality was a curve steepener, and I think we're back into that kind of environment. That makes it a little bit challenging for investors who are kind of cash limited because you don't get the same kind of return for a dollar investment. It means you need a little bit more flexibility in your portfolio toolkit to use things like futures and leverage to equate your diversification irrespective of where you are on the yield curve. And a little bit more flexibility in the toolkit allows investors like ourselves to be able to do that.
Hey, Jeff. Thanks for dropping by. Jeff Rosenberg there of BlackRock on the latest in this market. The latest on the jobs market, 177K, an upside surprise on a jobs report with an industry breakdown. Mike McKee joins us now with more. Mike, what do you got?
Well, John, looking at some of the areas where you would think the tariffs would have an impact, at least they might at some point. They haven't yet today. Retailers lost 1.8 thousand jobs, but building materials, this is the time of year when people would hire more for building materials and garden centers. They were up by 2.7%, by 2,700. And as I mentioned, construction workers were up. Healthcare and social workers, this is the category that would include some of the workers that would be laid off in terms of contractors or some of the aid programs that the administration has slashed, but they were up by 7,600. So we're still seeing people getting hired into areas in which you'd think there would be job cuts or that they may be coming at some point, but we haven't gotten there yet. Only 2,000 people listed as job losers this past month. So right now, it looks like the economy is still, or the labor market at least, is still pretty strong.
Mike McKee, thank you. Breaking down the labor market for us this morning, breaking down the commentary from the White House. Anne-Marie, the president, with a few things to say.
A few things to say. He's talking about gasoline. He's saying it just broke $1.98. I'm actually looking at what the national average is. It's just above $3. He's talking about energy down, employment strong, and get to the punchline, of course. He's saying this is a perfect moment for the Fed chair, Jay Powell, to lower interest rates. The jawboning, Jonathan, continues.
Stephanie, is it the perfect time for Jay Powell to lower interest rates?
It is not the perfect time. It's the opposite. The economy is running okay right now. They don't want to get ahead of this. They're going to have to just wait and see what the impact is from an employment perspective and then an inflation perspective, by the way. Inflation could be running up towards 4%.
Stephanie Roth of Wolfe Research is going to stick with us alongside Mohammed Al-Erin. The whole team is going to sit around the table to break down this jobs report with us. Just for now, though, I want to get you some top stories from elsewhere with some Bloomberg briefs. Where's Yahara Hacker? Say, Yahara.
Hi, John. Recapping that data, April payrolls topping forecast. The U.S. added 177,000 jobs, and the unemployment rate held steady at 4.2%. Looking under the hood, manufacturing jobs fell by 1,000, but transportation and warehousing added 29,000. Wages are also up year over year by 3.8%, outpacing consumer prices. We love to see that. Next up, we have China saying it's assessing the possibility of trade talks with the U.S. It's the first sign since President Trump hiked tariffs last month that negotiations could begin between the two sides. Still, as a condition to negotiations, the ministry asked the U.S. to show sincerity towards China by canceling tariffs.
Dollar's very confused right now, Gift.
And the White House is set to release the first budget
to be honest.
President Trump's second term. According to sources, the so-called skinny budget will call for $557.
I think Trump is in deep trouble, man.
A nearly 23% drop from current levels. Meanwhile, national security funding would rise to $1.01 trillion, which is a 13% increase from existing levels. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, we'll break down this jobs report, this market, and look ahead to the week ahead. From New York, this is Bloomberg.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China. In 2023, it's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising chorus conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
The opening bout just around the corner. Equity futures up by 1% following an upside surprise on a payrolls report. From New York City, welcome to the program. Looking ahead into the weekend and through to next week. Coming up a little bit later, you'll get data, durable goods and factory orders. Monday, ISM services. Tuesday, the trade balance. Wednesday, a Federal Reserve rate decision and news conference with Chairman Powell. And then on Thursday, another round of claims and a Bank of England rate decision. With us around the table, Mohammed Al-Arian and Stephanie Roth. Stephanie, what are you looking for in the data into next week?
Yeah, I mean, so certainly, well, let's just comment on today is, yeah, the economy is solid right now, but heading into the next couple of months, it's going to take a big turn. And by the way, one thing we didn't talk about yet was the foreign-born numbers within the payrolls print was a little bit softer. So this is something to keep an eye on in the next couple of months, is to the extent to which immigration is also having a negative impact on the labor market.
Mohammed, is that your worry as well, that in the next few months this data is going to weaken?
I do worry about the supply side. I don't think we pay enough attention to the supply side. And Stephanie is absolutely right. You should look at the various disaggregated data that give you some signal. You know, broadly, can I give a suggestion for the graphic you just showed?
Please do. What would you change?
You should have underneath, going across every single day, tariff negotiations. because I suspect that you'll be talking about that layer as much as you'll be talking about what's above.
Can you speak to the graphics department? Lisa, can we make that change next week?
So. Tariff talks will happen. Tariff talks may happen.
We can have
Maybe
that
that's
run across the bottom of the screen.
It will happen. You think so?
That could run across the bottom, couldn't it?
Well, this is the issue, right? So how do you interpret these numbers and how do you extrapolate them forward? And you pair that with what President Trump just tweeted or truthed or whatever you want to say, which is no inflation, lower rates. Are we trying to get ahead of something? Are we just reflecting what actually we're seeing? How is the administration's response to the incoming economic data going to cloud the equation on all sides when people still believe there is a Trump put?
I love the idea of a tariff ticker because I feel like I could help with it. Two things to watch out for today. Japan, they're coming out and they're saying the U.S. is reluctant on a number of issues that they need to see to get a deal. And of course, China. The driving force of all of this, when you talk about ships being backed up, China's very important. Maybe they're ready to come to the table.
Session highs in the equity market up by more than 1% on the S&P. After the commercial break, we'll be right here. We'll be catching up with the administration, reacting to the payrolls report. Stephen Myron, the chairman of the Council of Economic Advisors.
Welcome back to another special Mutua Madrid Open update for Bloomberg TV and Radio from Tennis Channel. Coco Gauff reached the championship match in the Spanish capital for the first time after she took out defending champ Iga Swiatek in straight sets. She'll face world number 1 Aryna Sabalenka for the title after she was just too good for Elina Svitolina. Coco leads their head-to-head 5-4 going into Saturday's showdown.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know.
Okay, so we are 3 minutes away from new hour candle forming, or starting. So far, it's more of the same, really. A bit indecisive from the dollar following that NFP news. Obviously, bear in mind that the news was actually positive. We should see higher prices, but it doesn't mean that will necessarily happen. But so far, bias for EU is still bearish. There is a slight divergence between EU and DXY. Right, so EU has played into its daily imbalance there, and it's starting to reject down lower, but it hasn't taken out the low. DXY on the daily has taken out its opposing high, but has not played into the imbalance. So right now, we're just trying to see which will line up. Okay. I also do like to see the gold come down lower, as I said prior. I don't know if any of you guys heard the gavels go off in the background, but I did take a small short on GU just to see what GU is going to do. I'm not really focusing on GU, but it looks a lot better than EU in terms of a short setup, so I've gone for that one quietly. What else? Yeah, just got to wait on gold. I want to see the hourly candle close, and then we'll go from there in terms of gold.
The Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
In case you missed it, on the China Show,
President Trump has called Wednesday Liberation Day, and that seems like liberation from the rules-based order on trade.
We're seeing a lot of orders being canceled, particularly on product being sourced out of China. There's a threat to seeing a shortage of certain products because, look, China's our #1 supplier of footwear. When I got this job 15 years ago, it was 88% of our volume to the U.S. It's now 56% of our volume. But the fact of the matter is, most of that volume is for price-conscious consumers here in the States.
One of the things you see here when you talk to suppliers and buyers is that this essentially gives Asia and Africa to Chinese supply chains an influence, because now as American firms have to focus more on the home market, the companies and organizations with the money to invest in new areas, that will be mostly Chinese money.
don't miss the China Show live every weekday.
The opening bell 30 minutes away, and going into that opening bell, equity futures near session highs up by 1.2% on the S&P, on the Nasdaq 100 up by more than 1 full percentage point. Sneak peek of the bond market, 2-year, 10-year, 30-year, yields higher across the curve, up by 7 basis points on a 10-year. Lisa, two things combining forces today. On the one hand, the prospect of talks between the US and China, and an upside surprise to the payrolls report.
This was a solidly and unquestionably positive payrolls report, coming in above expectations for the headline number, but also participation rate, also hours worked. So it raises this question: if we already have a really solid trajectory underpinning the economy going forward, how much can the U.S. boom should there be some resolution to some of the trade tensions?
That's the conversation we need to have right now for our audience worldwide. Welcome to the program. We can now get the reaction from the White House, the administration, reacting to a stronger than expected payrolls report. Joining us now is Stephen Myron, the chairman of the Council of Economic Advisors. Stephen, welcome back to the program, sir. Thanks for making some time for us this morning. Let's just take a little assessment of where things are right now. So through the week, GDP, first contraction since 2022, consumer confidence the weakest since May 2020, manufacturing shrinking on the ISM report, and then we just had this very solid payrolls report. What's your assessment, Stephen, of where things are at the moment?
Good morning. Thanks for having me. And let me just say that I know that surveillance usually ends at 9, so I look forward to you guys benefiting from the president's forthcoming no tax and overtime. So thanks for staying a few extra minutes. But no, look, I think there's been an ongoing disconnect between the hard data and the soft data, and the hard data continue to perform very well. 177,000 jobs last month, a beat of 40,000 jobs. That's the president's second jobs day beat in a row. And on top of that, you've got 11,000 construction jobs, expanding construction sector in spite of the president's crackdown on the border, disproving critics again. And the hard data continue to be okay. And I think it's worth emphasizing that these data represent the period after the president's historic actions with tariffs on April 2nd.
So, Stephen, we need to get into that because there are some people that we've spoken to that worry about the next report. They think that this could show up in the May report. And I've heard the words downside risk repeatedly. Are you confident that some of that's avoidable?
So, look, given the historic scope and speed with which the president acted to put American workers and firms first for the first time in decades, it shouldn't be surprising if there's some accompanying volatility, and that extends to financial markets that we've seen, and it could extend to economic data also as companies sort of substitute activity from one month to another. That remains to be seen. But so far in the hard data, we're not seeing any real evidence of that to be the case. And as you pointed out, there are various soft data sentiment indices that look not as good, but those tend to be influenced by financial markets. And there's been enormous volatility there lately, as you guys are aware. And they tend to be influenced a lot by politics. But historically, the correlation between those and activity has been weaker in the last few years than it would have been, say, 10 years ago.
We are seeing it show up in some hard data, and that's trade volumes. We just caught up with the Port of LA director, Gene Soroka. Stephen, I wonder if you've been in touch with them and how you see this playing out. They're telling us now that trade volumes are about to fall, that what they're about to see through their port could drop by something like a third, 30%, and then from there this could ripple through the US economy. What's the sequencing of things from your standpoint?
Thanks. So as I mentioned a moment ago, there can be some volatility in the economic data, and I think it's worth emphasizing that there are some firms that want to see the outcome of trade negotiations, which will be coming soon, and they want to see the tax bill passed, which again will be coming soon. And as a result, they may substitute activity from one month to another, from one quarter to another, but it all gets averaged out over time. These are not the types of activities for which activity would get canceled permanently. And as you mentioned at the start, the GDP report contained a 5-point drag from import activity. So we're just coming off of a quarter with an enormous amount of imports that by the way, there was a data anomaly in the GDP data that I'm sure most of your audience is aware of by now. But after such a huge import drag on the economy in the first quarter, it wouldn't be surprising if there were a little bit less imports subsequently. I mean, but this stuff all averages out over time. And that's why it's important to look at measures of underlying GDP growth, underlying economic activity, and those were quite strong.
As you know, the market's very focused on trade talks right now, and that's why we've seen equities recover to the extent they have over the past week. Stephen, the US says China wants to talk. China's going around saying the US wants to talk. I don't think the market really cares about that. The market just wants to see talks. What's the timeline for actual talks?
So the president has repeatedly said in recent weeks, and he's been very clear, that he thinks that we will do a deal with China. I think the president is right. And as I keep pointing out, the president has one of the best track records on making deals in the entire history of the country. He is able to pull deals out of a hat that nobody thinks are possible. He pulled the phase 1 deal with China out of a hat in 2018, 2019, in spite of all the doubters. Many people didn't think that was possible, but he achieved it. And so I think the president is right that we will have a deal with China. I can tell you, I can tell you that I have good reason for that optimism. I think that it's in the interest of both economies to lower the temperature, to create breathing space, to continue talking, to figure out how we can get to a new stable equilibrium on trade. And I think that a little bit of de-escalation will be quite helpful. So I would be surprised if tariff rates are where they are now, within a few weeks from now.
A few weeks. So you're saying within a few weeks, the 145% tariff rate on China is bound to come down, and to where, Stephen?
Well, I can't get ahead of negotiations. I can't make commitments. I'm not part of the trade negotiating team. I'm not a trade negotiator. But what I can tell you is the president has been very clear that he thinks that there will be a deal with China, and I think the president is right. And I think that I think it's in the interest of both sides to come to a de-escalation that lowers the temperature and creates breathing space.
Well, China this morning put out a statement, the Commerce Ministry, so this is official, saying China is currently evaluating this. Do you have a sense when the president is going to get on the phone with Xi Jinping?
I don't. And again, I'm not a trade negotiator. I'm an economic advisor. That's the scope of my role. What I'm giving you is my expectations. I can't get ahead of the negotiations. I can't commit anyone.
Stephen, I wonder if you could give us some insight, though, just to the approach we're taking at the moment. The Treasury Secretary mentioned just yesterday that maybe we could revisit the purchase agreements that we struck with China back in 2020. Is that something we'd look to do with other nations as well?
Look, I think that there's a wide variety of terms that can be included in the different negotiations, and each country is different, each trading partner is different, and I suspect that each trading agreement that is reached will end up being different too. But things like that should definitely be on the table, and I think it's up to other countries to show America that they mean to make trade more fair, they mean to make trade more reciprocal, and they mean to create better markets for U.S. exports the way that we accept their exports into our markets. And purchases like the type you're describing, could work towards that end.
Well, the Europeans are looking at increasing the purchases of U.S. goods to 50 billion euros to address what they say is the problem in the trade relationship. Is that enough to get a deal done between Washington and Brussels?
Again, I'm not a trade negotiator. I'm not making deals with people. I'm just an economic advisor. And, I can't say, I can't prejudge the outcomes of those deals. However, what I will say is that talking is better than not talking. And I do believe in the ability of the president to create deals that nobody expects. And once you start on that process, I think that there will be fertile ground for countries to see eye to eye, to make trade fairer, more symmetric, more durable, more resilient, and create a more long-lasting, stable global trading system.
Well, the Japanese are talking, and I think this is something that you can offer some insight on. An assessment on what this could mean for financial markets and the economy, and we'd love to know the kind of advice you'd give in the Oval to the President of the United States. The Japanese finance minister was asked if Japan's holding of treasuries could be a negotiation tool, and the response was this. Here's the quote. "It does exist as a card. Whether or not we use that card is a different decision." Stephen, what's your reaction to that?
My reaction is that I'm not the Treasury Secretary, and you should ask my neighbor a couple blocks down.
Do you have an assessment on what that would mean for markets and the economy, though?
I don't, but, for markets and the economy, I think that, capital flows will ultimately, in the long run, follow economic growth and economic opportunity. And that's why the president is focused on creating the most dynamic, strongest, healthiest economy in U.S. history. And we're talking a lot about trade, but there's two other elements to the package also, and those are tax relief for Americans, no tax on tips, no tax on overtime, no tax on Social Security, incentives for corporate investment, lower corporate rates on domestic manufacturing, expensing, things like that, and also deregulation, getting regulations out of the way so that American firms can produce in America without layers and layers of red tape that make financing difficult, that delay projects, and just make it unattractive to invest in the United States. And as we succeed in creating the economy we want by passing the tax bill, the big, beautiful tax bill, by proceeding with the deregulatory effort and getting government out of the way and putting American workers on fair ground via trade renegotiation and tariffs, then we're going to create the economy that will attract capital flows. So all of this stuff in the short run, it's a little bit noise, but in the long run, capital capital will follow economic opportunity, and this administration is focused single-mindedly on creating economic opportunity for American firms and workers.
So, Steve, let's quickly talk about the big, beautiful bill. What kind of revenue do you expect from the tariffs to offset the tax cuts the president wants to get across the line?
So when you talk about things like offsets, that's ultimately, usually people talk about that as part of the reconciliation process, which is basically as your audience knows, a legal artifact of how the sausage gets made in Washington and how bills, and how bills come together and get signed into law. The tariff revenue is sort of a different bucket. I'm not at liberty to share our internal number, but what I would say is I would be surprised if we had tariff revenue, that was less than hundreds of billions of dollars a year. And that's very substantial. So when you think about the revenue that you can raise from tariffs, ultimately paid for by foreigners, use that revenue to help finance preservation of the president's historic 2017 tax cuts, use that revenue to help finance additional tax relief for American firms and workers. I think that's a winning combination.
Steve, right now the market is basically just only pricing in the fact that there's going to be an extension of current policy. How confident are you that you get some of those sweeteners like you just mentioned, no tax on tips, actually done in this package, given how slim the Republican majority is in the Senate and the House?
Oh, I'm very confident that we will get this package over the line. I'm extremely confident we'll get this package over the line. The entire Republican Party is unified and committed to using tax incentives to create a vibrant, robust, healthy, and dynamic economy. And that was what created the first Trump economic boom, and it's what will help create the second Trump economic boom as well.
Stephen, just a final word on the Federal Reserve in May. The president's been outspoken, as you know. He said we should reduce interest rates. The Treasury Secretary, Scott Bessent, made the argument that, look at where the front end of the yield curve is right now, the 2-year trading below Fed funds. That's evidence that this market thinks we're too tight and the Fed should cut rates. I just wonder from your perspective how you'd weigh in. Do you think this complicates the optics for the Federal Reserve? Does it make it harder for them to ease over the next several months?
Sure. So, I think everyone's entitled to an opinion on interest rates and where they should be. And the president actually has a pretty good track record of his opinions. He was right in 2018, 2019 that inflation wasn't an issue and that interest rates were too high. And eventually consensus came around to his view. And again, he was right in 2021 that interest rates were too low and inflation was coming back big time. And again, consensus came around to his view. So everyone's entitled to an opinion on these matters. I think the president has a great track record on them, as does Secretary Bessent, who's a fabulous track record as an investor on these subjects, and everyone's entitled to their view. As to whether it interferes with the things you're talking about, I don't think so. I think the track record of the Federal Reserve speaks for itself.
Stephen, can I just say, I really wanted to catch up with you. I did this for free. No overtime, OK? But I'll take the tax break. I will take the tax break. Stephen, thank you, sir.
Well,
Stephen Moran.
The tax break is coming.
Thank you, sir. The chairman of the Council of Economic Advisors. With us around the table still, Mohammed Al-Arian and Stephanie Roth. Lisa, first to you. Wanted to come to you and get your reaction. The takeaway there, just on China, that those tariffs won't be around in a few weeks' time. They'll be changing.
They're going to be coming down to a significant place, not necessarily giving any commitment to what they're coming down to, but a sense of progress, which is what you're seeing reflected in the equity markets. What this means going forward for further talks, how complicated this is, and economic projections. I'll let the markets figure that out.
An olive branch very early this morning from the Chinese Commerce Ministry. Now an olive branch from the...
So I hope you guys have been paying attention to a little bit of the things that Bloomberg has been saying. So far, there really isn't much. Gold is dropping though, right? Gold is definitely dropping. Now, what I have planned out for gold is I'm looking for a pullback, right? And I want this pullback to potentially test this hourly candle, right? I've looked at Awanda's feed on the 4-hour. I like the closure of that candle. And I'm also looking at, other providers, FXCM, Pepperstone, even that 4-hour candle looks good as well. And I do believe that the next hourly candle should, or maybe this 4-hour candle, but the next candles coming should give us a pull back up, okay, which is going to give us an opportunity to enter to go short. I am bullish on the dollar, like I said at the start of the session. So let's just see if we do continue higher. I even really like GU. I do want to short GU. I think EU is an okay sell as well. Let me take a GU short here. I do want to take a GU short. Most likely put stop above this high here for a safer SL. I do want to take a GU short. It looks like we're slowly getting there in terms of a pullback. I'm going to hold on the GU short just for a second. I'm going to hold on the GU short just for a second. Let's see. Right now, you know, to be honest, I do want to see a couple of hour candles print, because this hasn't left the range, it hasn't left the news range. You know, we did look like we are going to progress higher, but now we're breaking the low once again. So that's definitely changing the picture. We've just got to wait. It's as simple as that. Just got to wait. So S&P's pumped up. Nasdaq's pumped up. Dow Jones pumped up. Yeah, stock market's back on the rise once again. Okay.
Issue that you're describing.
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Futures rally hard, 12 minutes until the start of the cash trade on this jobs day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shonali Bassick.
And I'm Katie Greifeld. We're wrapping up a packed week with a robust jobs report. You can see that futures shaking off some disappointing tech earnings last night, rallying. Exactly. Taylor Swift style. You can see the S&P 500 up 1.2%. We closed out 8 straight days of gains yesterday. If we make it to number 9, that'll be the longest streak since 2004.
Stocks to watch today include Apple. It plans to source more than 19 billion chips from the U.S. this year as part of a global supply chain shift to gradually lessen its reliance on China. It sees a $900 million hit in this quarter alone coming from tariffs. It'll be the first Mag 7 stock to drop on earnings this quarter.
Interesting. We're seeing Amazon saved by that jobs print. It actually turned in the green after we saw that. Yet it expects a tougher business climate in the coming months due to tariffs and a potential downturn in consumer spending, with the slowdown already appearing in third-party revenue.
We're going to dig into those reports in detail, but Bloomberg just spoke with Chairman of the White House Council of Economic Advisors, Stephen Myron, about the state of this labor market.
Given the historic scope and speed with which the president acted to put American workers and firms first for the first time in decades, you know, it shouldn't be surprising if there's some accompanying volatility, and that extends to financial markets that we've seen, and it could extend to economic data also as companies sort of substitute activity from one month to another. But you know, that remains to be seen.
All right, for more reaction to the jobs data, we bring in Bloomberg's chief economics and policy correspondent, Michael McKee, joins us here on set. And 177,000, better than the highest estimate in our survey. Is this economy on fire?
The economy was very strong coming into 2025, and the labor market was the strongest part of it, which the Fed has acknowledged. We are seeing a slowdown. We got 177,000 jobs. March was revised down to 185 after 58,000 jobs were subtracted from March and February, but it's still a healthy number. The 3-month average is 155,000 jobs a month. That's up from 133,000 last month. Unemployment basically unchanged, even out to 3 digits. Average hourly earnings, all basically unchanged on a year-over-year basis. We always talk about the biggest movers, but this time I looked at what.
Okay, we're getting some movement. Gold's pulling up. We got the dollar dropping as well. Okay, dollar's dropping. Okay, dollar seems to be dropping with a little bit of energy now. Okay. Gonna have to put that GU trade on back burner, because with the dollar dropping so heavy. All right, so for now, when I look at gold, we've had a slight play into this imbalance here on the half hour. 4-hour candle is flipping as well. Okay. Okay. Now here's the thing, yeah? Okay, so for gold, we can still take the short for gold. But because of how the dollar is printing right now, it becomes less of a high probability trade into a high risk trade. Now, don't get me wrong, gold can definitely still drop lower. It can do that, right? Just because it's pulling back up doesn't mean we should fear, or it's pushing up right now doesn't mean that we should fear selling gold, right? So in that regard, what I will do is still look to short inside this area. Okay, reduce my risk and short inside the area there. Okay, my short entry is 32.54 or 32.55. Okay, that is where I'm looking to go short on gold, just so that we're all on the same page. Yeah, DXY is continuing to drop. It's quite a nice candle forming there on the half hour. That candle's looking pretty wicked there on the EU as well. Let's just keep monitoring together.
Leisure and hospitality, you see some of the tourism data coming off. I think that'll start to flow through a bit. So I think the delta is to slower numbers. And you know, the interesting thing in the JOLTS report this week, look at job openings. That's actually, in some of the sectors I just identified, that's coming off. CEOs, CFOs are sitting in this point today, I'm just going to wait. I'm going to cut my job openings. I'm going to keep my labor in place in case economy actually does okay and we get through some of these tariffs. But it's really interesting. Openings are coming down. So the delta is lower, but it's coming from a pretty solid place. And services, when people keep, arguing U.S. economy, service economy is pretty darn good.
I wonder how important manufacturing.
Okay. So gold is now here. I'm going to take a small short for gold. Okay, I've taken a small short for gold now. So don't get me wrong, guys, yeah. In terms of gold, gold can definitely climb a little bit higher, but I do think this is not a bad area to start shorting gold from. So I've taken it. I know dollar is dropping and it is continuing to drop. I do know that. But that's why we're giving it quite a substantial stop. Okay, because if we're wrong, then, you know, I don't want to be wrong because of a few pips. I want to be wrong because I'm simply just wrong. Okay, so G is also pushing higher. It looks like the little setup that I was looking at is no longer valid. Okay, so for GU to remain bearish, still need to see this high maintained. Okay, so potentially could look at a session candle play for GU. But let's just see. We may rally for Tokyo Ranges high as well. I'm gonna set an alert for that over there. Let's just see what gold wants to do. So right now, no heavy lot sizes. Nothing that should be anything crazy. We're just seeing if we are onside or offside, you know. That's all what we're doing right now, just seeing if we are onside or offside. So officially, we have now pierced into that daily candle. Sorry, the daily imbalance. So now I'm sitting up. Right, I want to see if we can now look to get a push up out of this area higher. Okay, we'll see. If we don't, then that's totally fine. But right now we're inside of the discounted. Sometimes you just have to monitor until a better opportunity shows itself. So right now DXY is stretching lower and lower into the imbalance on the daily there for the dollar. I'm going to set an alert near around 50% of the imbalance there. And even when we look to the left here, right, there's one thing that I don't like, okay, about the price action that we had running up to this high. What I don't like is how we almost had, right, we almost had a trickle effect all the way up, right? What do I mean by a trickle effect? Like, don't get me wrong, inside this price action, we were heading up higher, but it wasn't smooth, right? It wasn't a high, low. We had a slight range, then we broke the range, came back into the range, then we pushed back up, right? Then we had this mini range, then we pushed out of it. Tokyo session, shot up, pull back, shot up, right? The only part of this price action where it looked pretty decent was here, right? That was the only part. High, high, low, high, high. So all of this, right, is liquidity, right? All of these lows here are liquidity. Now, the next question is, are we going to get a break now? Right? As in, is market going to now run for these lows now or later? I don't think it's going to do that now, but I could be wrong. And the main reason why I don't think it can do that now, or it's more likely to do that now, is because it's Friday. Okay? I'm anticipating how the weekly candle is going to close. Okay? Maybe potentially next week, right? We get a bearish start to the week, right? If we're going to come for those lows, right? Maybe we get a bearish start to the week and we take out this current week's low and then we attempt to take out the week's high. That's what could potentially play out next week. But for now, I'm playing the daily picture and understanding that we've pulled back into the daily imbalance. So I want to see if we can get a push up from here. Okay. Now, again, this is a big if. This is not like, you know, a certainty or whatever. It's a big if. Okay. So right now we are looking at potentially gold holding in and around where it currently is and giving us a shorting opportunity. It's not really doing too much, hasn't moved all that much just yet. So if any of you are looking for a little trade, you can enter this gold short with me. One, two, three, four. Okay, so let's see what happens with gold. We're holding where we are currently, pushing down a little bit. See what G is doing. It is stock open now. It is stock open now. Gold is dropping off. Slowly, slowly. Alright, let's see how this progresses for gold. I mean, it's okay. There's nothing really to scream home about. This can still just, you know, ruin the party and push up, but it does look okay. Is it an amazing picture? No, not yet. You know, I want to see some 15-minute engulfing, some half-hour engulfing candles, right? GDX has been printing lower and lower, which is good. But at least for now, there's nothing much to really scream about. So we'll just work with that for now.
On our own R&D, but you're going to have to suck up a margin hit. I think most analysts actually said, look, generally speaking, they beat when it comes to their operating income. They beat hard this quarter. Look, the guide, they're just being cautious here.
All right, Caroline, thanks very much. Bloomberg's Caroline Hyde. She hosts our technology show, which kicks off at 11 a.m. with Ed Ludlow, and you can watch that, well, at 11 a.m.
There you go.
As I said. We are back with BlackRock Chief Investment Officer of Global Fixed Income, Rick Reeder. Rick, you also run BINC, the ETF, which is outperforming the benchmark, really crushing it, and up year to date, as opposed to the S&P, the broader index, which is down still almost 4% year to date, still off 8% from its highs. What do you think about stocks after a 9-day winning streak? I mean, do you take some profits here?
So thanks, Matt. I mean, so I also run our global allocation fund where we do mostly equities. Listen, I'd say a couple of things that we're doing in the equity market. First of all, this is as good a trading environment as I've seen in a long time. You know, there was a period of time where people were panicked about the downside, and you could sell puts on the market, reduce your equity beta, sell puts. And now you've got this amazing froth that, you know, you ride it a little bit. You run your equity beta a little bit longer because the sentiment's good. Maybe you get good news on trade. But now there's a great opportunity to sell upside calls because people will pay for the up 10%, 15%. And buy some downside. And so that's what we've been doing recently. You know, ride this a little bit, keep your beta elevated, but you can buy some downside protection. And I think, quite frankly, you know, some of the names that are moving now in tech and otherwise, you can sell some of the upsides because people have gotten super excited again, and then protect yourself so you can ride an equity market. Listen, the valuations, you're talking about 22, 23 times earnings. These are not great valuations. It's a sentiment-driven market. And it's one that there's just so much cash that people are looking for an opportunity to put some money.
We've got heavy selling. So yeah, like I said, even though we're in a little bit of profit there, the dollar is heading straight back up there. DXY is very weak right now. It's very weak right now. Very weak right now. Okay, he's approaching this little sell setup. I'm gonna stay on the sidelines for now. Still gonna work with gold. Right, if there's anything I'll sell right now, it's gold. Dollar is just dropping out of the sky right now. Still dropping. G's looking like it's gonna clap this high. Gold is holding, guys. That's very interesting, you know? Take a look at how gold is holding right now. I mean, we'll see if we get a blip higher, but gold is holding at the moment. I mean, if gold does push up higher, like I said earlier, there's definitely, you know, this 4-hour candle that we can look at to go short. But for now, it's just holding. You know, it's probably bound to push up due to this dollar weakness. Heavy dollar weakness. Dollar's coming down. The only trade that we got so far is gold. Currently in a little bit of drawdown. Yeah, a little bit of drawdown. If you do, or if you are someone looking for a little setup, this is the setup that I have for this session, for this live stream. I don't think we're going to get anything until later. It's starting to seem like the dollar's decided on its direction for the rest of the day. Seems like it, okay? Look, we have a very strong engulfing candle this hour. So what I'm trying to see is the next hour, when we create the high of the hour, we pull back, right? And that pullback should, if we are still intact with gold, should give us enough, you know, energy to start dropping. Because right now, what we can see and what you guys will see in your day-to-day, you know, trading and whatnot, is there will be periods of times where the DXY is just dropping down and you're not seeing the equivalent happen on gold, right? You should see gold flying up, but it just doesn't, right? So what does that tell you? That just tells you that at that time period, if the dollar's dropping down and gold is resisting to push up, that means gold is also weak alongside the dollar, right? There'll be other periods where the dollar's strong, but gold refuses to come down, right? So what that means is anytime there's a slight push to the upside, a smaller push to the upside on the dollar will have a bigger push to the downside on gold, right? A bigger drop on the dollar will have a smaller upside reaction on gold, right? So if we look at from here to here, right, this happened, when did this happen? This happened from here to here, right? We had this nice move lower, gold move from here to here, and it stalled. See how we're getting a very small move, a very small pullback right now on the dollar, but then you're seeing a slightly bigger reaction from gold, right? So when you are looking at markets, these types of situations do happen from time to time, and it's really good if you can identify if it's beneficial for your trade or not, right? I understand, yes, the dollar is weak right now, it's weak and it's dropping, but right now gold is also weak with the dollar. So I know any slight pullbacks from the dollar is gonna create a big, or I wouldn't say big, it's not that big, but a much bigger or greater reaction from gold. Okay, and what we're getting right now is showing you what I'm talking about. That's a little tip there for you guys as well to take it on board. Yeah, so right now, looking at this, I still do like my chances for this setup playing out. We're almost, well, we're not almost, that's a lie. We're another 15 minutes away from the new hour candle. Okay. So we'll go till the new hour candle opens, and then we'll see how it does, and then we'll close the stream there, and then I'll update you guys inside of Discord. But so far, GDX has continued to drop since opening up from the pre-market, and it is still dropping right now. So it does look like this gold trade should play out. Should do.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season. Take a look at how.
Okay, so Joe says in the chat box, man, I need to take note of this information you're giving right now. Yeah, it's one of those things where you will notice through time. Obviously, the more time you put into something, you're going to start to see these patterns form. So obviously, what I've told you guys, just keep a mental note, or just watch gold. Or it's not even just gold, it's pretty much all pairs. It can be gold, it can be GU, it can be EU, like it can be the yen, the JPY basket, the yen index, and any other yen correlated pairs. You will see these differences, right? It could even be the euro and the pound, right? Euro GBP. Oh, guys, I want to take a short on GU and EU, you know. I do want to take a short. Let me take a small position. Small position won't hurt, right? They said. Let me take a little something something. And for GU, all right. So these other trades I've just taken, they're not the main trades. Like I've said to you guys, I've got separate accounts. What's my TP for gold? My TP for gold is the low, right, of 14th of April's daily candle. So it's around, let's just say, let me give you a whole number, 31.95. That's my TP for gold. Okay, so TP1 for gold's just been hit right now. Okay, so GDX is still dropping. If you want a easier target, like something that's more likely to be hit, I would most likely go for Tokyo's low. Okay. So it looks like this half-hour candle wants to engulf, you know? Looks like it wants to engulf. It looks okay in here so far. Looks okay. So take a look here. Look at dollar. Look at dollar just dropping, right? Gold is barely reacting. Just barely reacting. You know? Okay, new hour really soon. We'll see. We'll see in the new hour.
Generates pretty much the majority of their operating income, and the other business is retail, which is massive. And I think, you know, the opportunity there is huge as they expand into new categories and new offerings. So right now, I think a lot of investors still want to see upside and strength in AWS, that's kind of what carries the higher margin or value. Whereas the retail e-commerce business, people know they're going to fight for volume and share at the expense of profit. And I think that's just kind of a given. But again, it kind of makes it different from all these others. So that's why I feel like right now Meta and Microsoft are just cleaner stories with tariff and macro headwinds. Doesn't mean Amazon's not a great company. It just means it's got more risk associated, namely from that retail side.
Jordan, you really saw a tale of two cities this earnings season with the big tech giants. Are these kind of more business-focused sectors immune to some degree to recession? Because you did see cloud spending, for example, as you said, hold up. Meta reaffirming those CapEx plans. Does that hold, though? I mean, people are flocking to these to a relative strength relative to the consumer-focused names.
Yeah, I mean, that's always the debate that investors will have is how I wouldn't say none of them are immune. You know, when you see market weakness or any sort of risk of a recession, spending and growth will fall, obviously. But I think what's different this time is that companies are seeing cost savings and efficiency gains from moving their IT spend into the cloud. And they're definitely seeing benefits and are excited about doing more AI-enabled projects to drive, you know, either better customer support, customer relations, also take market share from their competitors. So that's what I think has held up the best is the cloud and the AI spending. But general enterprise, you are seeing some companies take longer to close on deals or size them down. And I think the debate is going to be, where are you most insulated within these IT tech companies? Like, do you want to favor large mega global companies that have, you know, a very diversified footprint, or will the more nimble, smaller companies that focus on small to medium businesses be safer because the deal sizes are smaller? But right now, I think people are favoring probably the larger size companies.
Jordan, great to get some time with you. Hope we can catch up again soon. Jordan Klein there of Mitsuho talking about the big tech earnings that we've had. Obviously, the M's were yesterday, the A's today.
They didn't do as well as the A's, but still, that's not stopping this market right now with the S&P 500 higher by about 0.9%, now 0.8%. Some of those early gains just lessening a little bit, but still, the S&P 500 now for the year only down 3.4%. Much more coverage of this market coming up next. This is Open Interest.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
All right, so we're about 5 minutes out from the new hour candle. I'm just watching how these candles are closing, and it still looks pretty good to keep coming down. Yeah, this hourly candle's okay. It's okay right now. It's just okay. Yeah, that's all I can say, guys. It's okay. Gold is looking okay. It's not amazing, but it's not terrible either. If we can break this low here on gold, then we've got a really good chance of taking out this yesterday's Tokyo ranges low. As long as we can take out this low, you know, preferably I want to see bodies of the candle closing beneath the low. If I can see bodies closing beneath the low, then we look good. But until then, we just kind of got to float. EU is in, I think, 1 pip drawdown, 2 pip drawdown. GU's in profit. Gold's in profit. Alright, cool. We've just got to work with that. GDX keeps dropping, man. Just keeps dropping. Keeps dropping. Hope you got that TP for gold there, Mark, yeah?
At the top of the next hour, we get factory and durable goods orders for March, so Mike McKee will be watching those closely. Tomorrow, Berkshire Hathaway holds its annual meeting in Omaha, and the Buffett indicator shows that stocks are still cheap, by the way. Jess Menton writing on the BN side. On Monday, we kick off our special coverage of the annual Milken Institute Global Conference, so you better believe Shinali's on a plane there this weekend. Treasury Secretary Scott Bessent will be on Capitol Hill Tuesday, as we told you about, and Wednesday as well. We'll show you both of those testimonies. On Wednesday, the Fed decision and Powell's news conference, and that means we also see Tom Keene back here on TV. The Fed decides. Coming up next, PIMCO's Tiffany Wilding joins us here on Open Interest, then David Kelly from JP Morgan.
Couple of minutes to the new hour.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Okay, new hour is here. New hour is here. So, we haven't really gone anywhere. As you can see, we've just closed doji. would still like us to head down lower. But for now, we need to see this hour make the high of the hour before giving us the low. Now, with this new hour, it has the potential to test this up candle again. I would prefer for just a minor pullback. Yeah, just a minor pullback, and then just engulf the previous hour. That's what I would prefer to see. Okay, we'll have to see because dollar's just still going.
The move comes just
Dollar is still going. So guys, I would just take it easy with the gold setup. You know, dollar's really still going. In any case, make sure you guys are all using appropriate risk management. Make sure your position is not too big where you're going to feel tempted to close the position. If your position is too big and you close position and then gold goes into profit, you're going to have no one else to blame but yourselves, okay? So for me, my position is not too big where I don't mind it going back up to drawdown or potentially hitting stop. I'm happy with leaving the week like that, okay? Again, guys, I will update you inside of the Discord. I don't think there's any other news releases, is there? Hold on, let me check. No, that's all the high impact news for today. If you guys have any questions, feel free to let me know. But I will be holding my positions. Okay, I will be holding my positions. I still do want to see gold come down. I do want to see gold come down. Anywho, I'm going to leave it there. See you next week. Have a good weekend, team. Yes, guys, have a good weekend. I will update you inside the Discord. Guys, if you have any setups, don't forget to post inside the Discord. Let's have conversations about just whatever you guys are looking at, what your setup is, why are you taking a short here, long here. Let's get the Discord jumping. All right, money day. Ooh, looks like gold might move a little bit, you know, give us a little something. You gonna do it, gold? You gonna do it? You gonna do it, gold? I like this 5-minute candle. I like this 5-minute candle, gold. If you close like this is a really nice candle. Oh, GDX is also dropping. Money day, everyone. See you next week. Peace.